Bring that ass back like a boom, 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 boom.
So I will start with the sectors in the row that I haven't set up on my watch list. So the first one is the XLC communications, and you definitely can see that this has been beaten down. We tried to rally off right here of this high, but in general, this is the weekly chart on the left. This looks rather weak. And if you look at the daily, let me just maximize the sell. If you look at the daily, we tried to break above the 50. We did actually accomplish this for a couple of days, and we're moving down again. Now, the really important indicator right here to look at is this relative strength compared to the S&P from the beginning of the year. You can see the green line. We're definitely moving quite below the mean. XOC is definitely on the lows right here, and it's not a sector that we want to take a look at for some place. Next one, we move to XLY, consumer discretionary. Pretty much the same thing, although relative strength is a little bit better. We tried to rally, and we were rejected by the 200-day moving average, pretty much in sync with what S&P 500 has been doing. And as you can see, the relative strength is not that far off the mean right here. You will probably have some questions about this boom supernova here at the bottom. This is, most of you are familiar with John Carter's squeeze indicator, or Mark Minervini's volatility contraction pattern. Basically, this is an indicator I'm working on and experimenting with that is looking at some very tight zones. So it's much faster than the squeeze and so forth, and gives early warnings where we can expect to see some explosive moves now, especially when you combine it with my volume indicator right here. So anyway, looking at XLE, basically showing the exact same characteristics of the S&P 500. XLP, we have the consumer staples right here, which are exploding, and this definitely has something to do with the inflation and inflationary prices that are rising. But ever since we recorded this drop right here on that was the 15th of March, we've been on a tier, and we've moved, let me just measure that, we've moved, do I have it, we moved almost 10% in just about a month. So XLP is definitely showing some strength, and we can definitely look at some place right there, although we're at the all-time highs, and this sometimes can be a place where we reverse. So XLP is one of the stronger sectors. Let's look at XLE. I'm sorry. And XLE is setting up again. I don't like it, but XLE is setting up again. It just looks fantastic. It broke out on Friday, although we did not get to all-time highs. And the other thing that you really need to pay attention is the lower volume right here. You definitely need volume on the breakout. So if we take a step back, and let's just end right here on this breakout, very similar situation. On this breakout, we had volume that was larger than the average, and if we move one day, let's just move one more day, as you can see right here on this doji type of candle, we had huge volume. So we definitely need to see more volume from these breakout bars right here. And if history is of any reference, Monday we should see whether we can move higher or not, but definitely we need to see the volume. So for now, XLE and XLP look somewhat okay. XLF, another one that is not showing relative strength, it's right there, definitely doing better than XLY and XLC, but still that's a downward looking slope for sure. And basically you can draw a channel again, extend to the right. We are holding this support zone right here. We are holding this, which is the good news in terms of financials. But keep in mind that if inflation is to rise and yields are going higher, Um, this will make the financial services suffer quite a bit. So I wouldn't really play the XLF right now, although this might be considered a bottom right here. So we might look at some tickers that are showing high relative strength in the XLF compared to others, but for me, XLF is a no for now. XLV definitely being one of the stronger ones here, and you can see the relative strength line here is off the charts, way above our average line right here. We are at all-time highs, just like the XLE and the XLP. So this is something that we can look at. Some of the stocks in this ETF already broke out, like REGN, and we have some positions right there. So let's look at XLI for now. Industrials again, relative strength below this middle red line, which is basically our benchmark. Looking similar to XLF, if you recall, we had this bottom that held. Now, if we draw this trend line between those two lows, you can see that there is still some place to go to reach the bottoms, but definitely looking weaker than XLV, XLE, and XLP. Then let's go to one of my favorites, which is the XLB. Materials. Now materials formed some sort of a top right here. They were supported by the 20-day moving average, so it's up in the air to see whether we can find something to play. But if we break those two trend lines right here, we might actually see some nice plays happening from this. And as I said, especially with coal and gold now going into value again, being searched by investors, I think that XLB has some room to go up. XLRE setting up really nicely right here. There was a play for XLRE. I don't like it because it's slow, but you could have definitely picked up some shares on the break of this price level right here. As you can see, that was quite a strong break. Let me just zoom in a little bit. As you see, that was quite a strong break. We've had volume on the rise right here, and we gapped over basically the prior high of this base formation. So that was a really good place to buy some shares and place your stop right here below the gap. Now we also saw some volume coming in right here, tightening. As you can see, my indicator is showing that there is some tight action right here. As you can see, like tight candles. This one is also a tight candle, and here in the base information we had 3 very tight days before we started to explode. So I think this is definitely a good sector to look for some trades, although as I said, real estates tend to be quite slow. Now let's go to technology. Oh, this is gonna be bad. Technology is definitely looking very weak. As you saw, we closed below the 50, below the 20, which is the sign line, below the 10, pretty much below all key moving averages for me. And we had some strong volume on this bar right here around the 50 and the 20. As you can see right here, this is a volume that is higher than the regular volume, and that didn't help, and we started moving downwards again. So that definitely looks quite bearish, just like QQQ. And last but not least, we have the utilities, which again, given the high prices of basic materials, given the high prices of energy and inflation figures, they broke out right here 2 weeks ago, and they've been on a tear ever since. So if you were playing this and if you're playing just breakouts, you could just buy the break of this, basically buy the break of this three line touch trend line. Right here, there was no volume, but what is important to note here, when the breakout happens, you don't necessarily have to have the breakout on the first day. That's important to know, but you definitely need to see some volume coming in. And as you can see right here, the breakout happened on very low days. Red red is very low in terms of relative volume, and then we had some accumulation of volume and this huge bar on high volume within the advance, which also shows some institutional buying right here. So of all the tickers, of all the sectors that we said, if you are going to be looking for a trade, XLU looks a bit extended to me, but it's still something to consider. XLRE, I said it's low, but you can definitely play this as a high handle right here. If we break this high on the higher volume, you can definitely look for some trades. So a marker for you would be 49.96, basically $50. That'll be a marker for you to look for a move up to 52 and all-time highs for the XLRE. XLB, I said I'm looking for some potential trades. If we can break this little formation, you could say it's a handle, although I don't really like those two candles that were below the formation. But if you think about it in terms of market psychology, and you draw, let's just draw a rectangle here between the highs. Okay, so we're drawing it. I'll show you what I mean. If you draw it like this, so basically what you're doing here is you're connecting the high and the low and drawing a rectangle. What you can see right here is happening on this gap down right here. There were people that covered basically covered their short positions, but there were people that shorted and people that got out of longs. Now with this candle right here, everybody's thinking now what's going on. I shorted right here and I got out of my longs. Now we're having a positive day, but pretty much everyone that got out of their positions or shorted on this day right here, now with this gap up again in the zone, is pretty much screwed. So they have to go back and revisit their positions. And since we had a lot of volume right here, I would guess that either a lot of people covered their long positions with this gap down, got out of a loss, or a lot of people shorted. Either way, it doesn't really matter. All the people that shorted now, and the candle being back here in the range, will have to think again and be like, maybe I was wrong with shorting, so now I have to cover, which is essentially buying. And the people that got out of their long positions will be like, well, I guess I was just fooled out. So maybe this was just, a leg down to fool me, to get me out of my hand, and basically shaking out weak hands with this, so to say, like a screw candle, and they will try to get in again. So basically, I'm looking for volume here and a huge white candle to support my thesis, and we'll see how this one plays out. We also have XLV, as we said. We have XLP, and basically these are the sectors that you can look for to set up some place in. So as I mentioned, I have a couple of notes here that I think are about to, to shape the markets in the next couple of months to years. Now, the first problem that we have obviously is the war, and all the other things, but for the Fed's hawkish actions, are consequences of this war. So the first thing that happened was, of course, the war broke out between Russia and Ukraine. Russia invaded Ukraine, and no matter how you look at it, and believe me, there are different ways to look at it, but no matter how you look at it, this creates some tension in the world, and financial markets are certainly a place where tensions are felt. So the first thing that happened after the war is we got some sanctions, and we got some prices of commodities going up. These were like food commodities, fertilizers, oil, gas, coal. And this is a natural reaction of war. Now, bear in mind that throughout the history, the moment that war breaks out, the market rallies. This is because usually all the events leading up to war events are basically priced in. So the market drops before the war, and it rallies after the war breaks out. We saw the same thing right here. However, as we noted earlier in the video, volume was very light. So not really a bullish rally. It was more like a bearish it was more like a bullish rally in a bear market, so to speak, like a bearish rally. As I said, we had some sanctions on coal, oil, gas that are basically affecting Europe and United States to some extent. Although there have been reports that the United States has continued to purchase oil and gas from Russia through some financial mechanisms. Anyway, no matter how you look at it, this causes some problems, and the United States promised that they will start unloading quantities of oil through their oil reserve, so basically dampening the price. However, the Saudis are not playing along this game, and per a recent report in The Guardian, the United States and Saudis relationship is on the verge of a break, which also leads to another problem. Saudis and Russia are moved by all these sanctions and foreign policies by NATO and the United States in the hands of China. China has agreed to buy more oil from Russia and the Saudis, and in basically a reverse action, the Saudis and Russia have agreed to remove large quantities of US dollars with yuans as their reserve currency. Now, I would say that this is a bigger problem for the United States than actually is Russia right now. And I think that sooner or later, United States will realize that they're losing their world dominance because of some actions like the sanctions on Russia right now. But it's up to be seen. So basically, the biggest problem I see right here is not so much the higher prices of coal, corn, oil, gas, food, exports in general. The bigger picture, I think, that is problematic is that the United States is actually losing control as the world dominant country in terms of finance, and the dollar is losing its value as a world reserve currency. That's basically, if I have to put my notes in a couple of words, that will be the big problem. United States dollar losing value as a world reserve currency. Now, number 5 here is the Fed hawkish actions, and even the most dovish members of the Feds are now open publicly to the idea of accelerated rate hikes because they realize that they are behind inflation and inflation is getting out of their control. This is the other part that I really don't like about our current environment, and therefore I've said it in Discord, I've said it in our videos, we have to be extremely careful when we trade. Cut your exposure, very tight stop losses if you can, and if you're familiar with options, try to trade a little bit more in terms of trading options, not because the premiums are low, not at least. Premiums are high as hell right now, but at least your downside is limited. Well, unless you're selling naked calls or naked puts, but in general terms, your downside is limited when trading options. So try to look into this or do some more short-term trading like intraday trading. Don't bump your overnight exposure to high levels. Market is extremely dangerous right now. So this is about my notes. I just wanted you guys to understand that there is some caution that needs to be exercised. And now we're going to look into the industry groups, the high performers and low performers, then sentiment, and we're going to hit it with our summary. All right, when we talk about top industry groups, this is the picture for this week. We have chemicals and agriculture on top. They were number 4 last week, and they basically overtook oil, gas, and exploration and production for international companies. So now we have a new leader, chemicals and agriculture. This is definitely MOS, one of the top companies in the market right now. And the rest is pretty much unchanged. As you can see, these are the spots from last week. We have energy, coal, we have oil and gas, steel producers, still 7th spot from last week, same place, mining and metal ores. Eighth place last week, same thing. And media periodicals, they dropped last week to 14, but as you can see, 3 weeks ago they were still at number 4. So nothing really has changed. And here are the top industry groups in terms of moving from last week to this week. Now, most of them don't fall into top 10, but they have made the biggest progress. And here in parentheses, I've listed the top tickers from each category. One that is really notable here, and we saw it with some of the breakouts working. We're right here, retail and wholesale of auto parts. This is AZO, Orly, CPRT, pretty strong names. So also Medico and Biomed, REGN, moving very, very well. Feel free to pause the video right here and check those tickers for yourself. I think some of those might be breaking out for this week and are really something that you need to pay attention to. Now, looking at the worst industry groups, there's absolutely no surprise that we'll be talking about XLK, technology, related companies most of the time. As you can see, computer integrated systems, computer software enterprise, computer software education and media. Pretty much 4 of the bottom 10 groups are computer related, and here is their group change for relative strength group change for the last 3 months. See, they're dropping big time. I've also listed the groups that are falling the most from last week to this week, as well as the tickers in parentheses again. Notable mention here deserves number 2, electric semiconductor, which are AOSL, NVIDIA, AMD, AFGO, Rambus. Pretty much all of these are well-known names, and they're looking. I was actually looking at AMD now. It's about to make a 52-week low below the 100 century mark, so this is something that we might play to the downside. Also, another notable group here is the leisure lodging with Marriott, Hilton, WH, building construction periodicals. We have ATKR, Builders Group. And in terms of transportation, we have JB Hunt also at the bottom. So there's some shift in the bottoming groups. Electronic semiconductors is a favorite one for breakout traders, but we're definitely seeing no traction right there. So this is as it pertains to the industry groups in general. And now we're going to move into our sentiment and then cap it off with the summary. So let's talk about sentiment for a little bit. The first thing I want to show you is the sentiment of the bulls investors. We were trying to get into the middle zone right here. If you notice right here at 3280, but then last week we just dropped again, and we are going again looking to attack these lows right here, which is a contrary indicator, basically signaling if bulls are extremely pessimistic, that usually means that we are near a market bottom, but still nowhere near the recent levels. So it's up to see how we develop next week. In terms of the bears, pretty much the exact opposite picture. We went to the mid zone about 25, and this week we jumped again to 41. CNN Fear and Greed Index is up and running again. You can see how it's reading the market so far at almost neutral. Previous close was at 60, at 46 again is neutral, and 1 week ago was 45 neutral. So we are above the levels 1 month ago, almost the same place we were 1 year ago with 51. Up to see how it goes. And here is the Fear and Greed Index during the period of the last 2 years. One thing that initially struck me as I looked at this graph, you can see is the lower highs that we are making. First in October last year we were at 75, then we went to about 70, 68, 70, and now we barely got to the 50 line zone. So although the lows are pretty much at the exact same spot, so not looking very bullish to me, at least, is the levels of the Fear and Greed Index. And this is for crypto. Bitcoin Right now the levels are at 34, and the good thing is that we are relatively high up in the chart of Bitcoin, and we are still quite low in terms of fear and greed. So basically, people are quite bearish at this level, which is a rather high level for Bitcoin in general in terms of price. So that's actually pretty positive in terms of sentiment for the crypto. And as I've continuously said, I think crypto is actually acting very well for what it's worth in the rest of the market. Finally, let's do a summary of the market. In what we have right here is our risk vest on neutral, setups are selective to none. The market is in consolidation phase. As we saw, most of the indices were rejected of their respective moving averages and now are in consolidating areas, and some of them are even breaking to the downside, like the QQQ and the small caps Russell IWM. The put volume is still in neutral zone. It was 0.7475, which is not elevated enough. It's not above the value area of 1, where we say that there is more put buying than call buying, and people are really looking for a run to securities. Lastly, volatility, as we saw, VIX is hanging around its 20-day moving average, so nothing really spectacular here. Although if markets continue their move to the downside, expect volatility to increase. And last but not least, we've listed here the rates, and not so much the rates themselves, but the Fed's intention to accelerate the rate hikes. We also have inflation and, of course, the war conflict between Russia and Ukraine. In 2 words, be careful, very selective in the setups, don't put a lot of risk, and be very tight on your stop losses. So that was it for this week, guys. I'll see you in our Discord server where we talk more about the markets and potential setups that we see. Have a happy trading during this week, and again, be careful. See you guys.